Hello, everyone. Today we're going to explore the fascinating world of business cycles and how they impact different sectors of the economy. By the end of this session, you'll understand the phases of the business cycle, how credit cycles interact with them, and how sectors like consumer spending, housing, and external trade are affected. Let's dive in. Before we get into the details, let's outline what we'll cover today. By the end of this session, you should be able to describe the 4 phases of the business cycle. Explain how credit cycles amplify business cycles. Analyze how resource use, consumer activity, housing, and external trade vary over the business cycle. Understand the role of economic indicators in predicting and analyzing business cycles. Let's start with the basics. A business cycle refers to the fluctuations in economic activity over time. These fluctuations are natural and occur in all market-based economies. The business cycle has 4 phases. Expansion. The economy is growing and real GDP is increasing. Peak. The economy reaches its highest point before starting to slow down. Contraction/recession. The economy shrinks and real GDP decreases. Trough. The economy hits its lowest point before starting to recover. These phases are illustrated in Figure 13.1, which shows the business cycle as a wave-like curve. The x-axis represents time, and the y-axis represents real GDP. The curve goes up during expansions, peaks at the top, then falls during contractions, and bottoms out at the trough before starting to rise again. The average line represents the long-term trend or potential GDP. Let's take a closer look at Figure 13.1. The curve shows the fluctuations in economic activity over time. During the expansion phase, the economy grows and real GDP increases. At the peak, growth slows, and the economy starts to contract. During the contraction phase, real GDP decreases, and the economy shrinks. Finally, at the trough, the economy hits its lowest point before starting to recover. The average line represents the long-term trend of GDP growth, which is where the economy would be if it were growing steadily without fluctuations. Now, let's break down each phase in more detail. Expansion. This is when the economy is growing. Employment, consumer spending, and business investment all increase. Inflation also tends to rise as the economy approaches the peak. Peak. This is the high point of the cycle. GDP growth slows, and inflation may continue to rise. Businesses and consumers start to become more cautious. Contraction/recession. This is when the economy shrinks. GDP decreases, unemployment rises, and businesses cut back on production and investment. Trough. This is the low point of the cycle. The economy stops shrinking and starts to recover. GDP growth turns positive, but employment growth may lag. Next, let's talk about credit cycles. Credit cycles refer to the fluctuations in interest rates and the availability of loans, or credit, in the economy. During economic expansions, lenders are more willing to lend, and interest rates tend to be lower. This fuels further growth but can also lead to asset bubbles, like the housing bubble that contributed to the 2007 to 2009 financial crisis. During economic contractions, lenders become more cautious. They raise interest rates and tighten credit availability, which can make the contraction worse. Credit cycles often amplify business cycles, making expansions stronger and contractions deeper. Now, let's look at how businesses adjust their resource use during different phases of the business cycle. One key indicator is inventories. During an expansion, businesses build up inventories to meet growing demand. But as the economy approaches a peak, sales start to slow and unsold inventories pile up. This leads businesses to cut back on production, which can trigger a contraction. During a trough, the opposite happens. Sales start to pick up, and businesses find their inventories depleted. They increase production to meet the new demand, which helps the economy recover. Firms also adjust their use of labor and physical capital. During expansions, they might add overtime or hire temporary workers before committing to full-time hires. During contractions, they might reduce hours or defer maintenance on equipment rather than laying off workers or selling assets outright. Let's move on to consumer spending, which is the largest component of GDP. Consumer spending tends to rise during expansions and fall during contractions. But not all spending is the same. Spending on durable goods like cars and appliances is highly cyclical because these are big-ticket items that people delay buying during tough times. Spending on services like travel or dining out is also cyclical but less so than durable goods. Spending on non-durable goods like food and household products is relatively stable because people need these items regardless of the economic cycle. The housing sector is another important part of the economy. It's highly sensitive to business cycles because it depends on factors like mortgage rates, income levels, and demographics. For example, when interest rates are low, more people can afford to buy homes, which boosts construction and related industries. But if home prices rise too quickly relative to incomes, housing activity can slow down, even during an expansion. Now let's talk about how external trade, imports and exports, behaves during each phase of the business cycle. Trade is a critical part of any economy, and it's heavily influenced by both domestic and global economic conditions. During the trough, at this stage, the economy is starting to recover from a recession. Foreign economies are also likely recovering, which means demand for our exports begins to pick up. However, domestic demand is still weak, so imports remain low. The currency might depreciate, making our exports cheaper and more competitive on the global market. This helps boost the economy as it moves into the next phase. During expansion, as the economy grows, so does domestic production and income. This leads to higher demand for foreign goods, so imports rise. At the same time, foreign economies are also growing, which increases demand for our exports. However, as the economy strengthens, the currency may appreciate, making our exports more expensive for foreign buyers. This can slow export growth, but overall, trade activity is strong during this phase. At the peak, the economy is at its strongest, but growth is starting to slow. Foreign demand for our exports may stabilize or even decline as global growth slows. Meanwhile, domestic demand is still high, so imports continue to rise but at a slower pace. The currency may remain strong, which can lead to trade imbalances, more imports than exports, which can be a warning sign of an upcoming contraction. During contraction and recession, as the economy shrinks, domestic demand falls sharply, leading to a significant drop in imports. At the same time, foreign economies are also slowing down, so demand for our exports declines. The currency may depreciate, which can help make our exports cheaper and more competitive, but overall trade activity is weak during this phase. In summary, external trade is highly sensitive to the business cycle. Exports and imports rise and fall depending on both domestic and global economic conditions, and currency fluctuations play a key role in shaping trade dynamics. Understanding these patterns helps us predict how trade will behave during different phases of the cycle and how it impacts the overall economy. To analyze business cycles, economists use economic indicators, which are divided into three categories. Leading indicators. These change direction before the business cycle does. Examples include stock market performance and new orders for goods. Coincident indicators. These change direction at the same time as the business cycle. Examples include GDP and employment levels. Lagging indicators. These change direction after the business cycle. Examples include unemployment rates and inflation. These indicators help economists and policymakers predict where the economy is headed and take appropriate actions. To summarize, business cycles are a natural part of any economy. They consist of 4 phases: expansion, peak, contraction, and trough, and are influenced by factors like credit cycles, consumer spending, housing activity, and external trade. By understanding these cycles and the indicators that track them, we can better predict economic trends and make informed decisions. Here are the key takeaways from today's session. Business cycles are recurring but not regular in timing or severity. Credit cycles can amplify business cycles and lead to asset bubbles. Economic indicators, leading, coincident, lagging, help predict and analyze business cycles. Consumer spending, housing, and trade sectors are highly sensitive to business cycles. Thank you for your attention. I hope this session has given you a clear understanding of business cycles. If you have any questions, feel free to ask. Thank you for learning about business cycles with me today. I hope you found this session informative and engaging. Have a great day.